Hello and welcome to the HCM Market Brief. My name is Doug Johnson. I'm the Senior Investment Strategist here at HCM Wealth Advisors and CPAs. And I'm joined always by my colleague, Dan Rinck. Dan is an investment strategist with the firm and also a member of our investment committee. Dan, we've got a video bonus today.
Video bonus.
Video bonus. We've got some charts in here that I think are going to be helpful to look at. If you happen to be listening to this on an audio only format, or if you're interested in receiving the slides after the fact, please reach out to your advisor. We'll be happy to send those along to you. So let's go ahead and jump right into it. July. So we're officially halfway through the year. And I think it's just like last year, it's been kind of a unique first 6 months. Last year we had the tariff situation. This year we had the conflict in Iran, both causing a fair amount of volatility right around the same time in the spring. But if we look at returns year to date, they kind of match up with last year. But there's a few nuances here. What we can see is here all these returns are positive. All of them are double digit positive, except for we'll call that magenta, I guess. I don't even know what color that is. But it's down here at the bottom. So 3.9%, we have the Russell 1000 growth. Then as we move up, we have the purple, which is the S&P 500, the blue, which is the international ETF. Then we've got brown, which is Russell 1000 value. Then we have 22 in orange, which is small cap. And then here at the top, we have emerging markets. So, Dan, I guess what sticks out here from these numbers? And I think it's important to note these are year to date, and we're going to look at a different time frame in just a second. But what jumps out to you from this?
Well, I mean, if you were to tell me all of the headlines that we had faced in 2026 and, going to war with Iran and all these things, new Fed chair, and these were going to be the asset returns, they would be all very surprising to me. But, for the longest time, it's been kind of a growth story. Ever since coming out of COVID, growth has been really the main driver. The Mag 7, we've talked about the largest growth names in the S&P 500 and the NASDAQ really driving a lot of the returns. If you told me that there was going to be another massive AI narrative push going into the first 6 months of 2026, I would have said that the growthier portions of the market were going to benefit the most. And obviously, that story is kind of flipped on the script, or, is kind of completely different than what you would expect. You're seeing international, you're seeing, smaller names, you're seeing value names really outperforming this year. It's definitely a surprising market. Again, going into 2026, knowing everything that was coming down the pike, I definitely would not have thought that this would be the picture so far, 6 months into the year.
Yeah, I would agree. We look at the Russell 1000 growth index being at the bottom, and if you were to look at the composition of both the Russell 1000 value and the Russell 1000 growth, they're very different in the way they're constructed. Russell 1000 value has, I think, the top position, maybe JP Morgan with like a 3.5% weighting. And then you've got, some similar names in there that have similar weightings. It feels more balanced. If you look at the Russell 1000 growth, it is Mag 7, maybe one or two other names, and then just a flood of names that have 1.5% allocation to the benchmark. So when we look at the Russell 1000 growth here, it almost still feels like a Mag 7 story. And the Mags, I mean, you're starting to see Mag 7 names get moved into the value index. So Amazon just got moved from the Russell 1000 growth to the Russell 1000 value, which I found surprising. But I think there's parts of the market still that are performing well, and we'll see those here in a little bit when we go over these AI themes that I would still consider like the tech part of the market, which I think traditionally would lean growth. But I think some of the index composition here is really starting to show through. But remember, this is a year to date number, but I want to show from what we'll call the first signs of a ceasefire in Iran, which I guess we can consider kind of the market low. But if you look at some of these numbers, they move around a little bit here. So you've got small cap being the best performer there. So small cap was a good performer year to date. Then you have emerging markets. So these kind of flip flop positions. But now you look at the Russell 1000 growth, and it has made substantial ground up since then. And the value index, while still performing very well, it's a little bit under that. And then you've got everything else kind of clustered there. So I think as we've seen this kind of risk off move, or sorry, risk on move since the bottom, we've seen a little bit more of a kind of normal bull market action, so to speak. Whereas I think a lot of the year to date numbers were skewed a little bit from those first few months and then into the initial Iran conflict headlines. I think the question going forward is, do we revert back to how we were, or does this pattern continue to hold?
Sure. And again, a lot of the story that we haven't really touched on much with the growth indexes is software. Software is pretty much the reason that the growth index has lagged so far year to date. Got absolutely crushed in the whole AI trade. Basically, AI is going to replace all the need for enterprise software. Claude is going to be able to code whatever you want, and you won't have to buy a CRM anymore. You can just build it yourself. After the Iranian conflict, I think some of those names got so oversold and the narrative is flipping a little bit. You're starting to see those software earnings come in and they're actually growing with the AI movement. ServiceNow, I think, is one where it has been absolutely punished, and it's kind of tells the whole story of the software sector. But the AI portion of their company is growing and growing and growing. So I think coming out of the bottom, not only have you seen a broadening across all asset classes, you've been seeing a broadening within the tech industry that to not just be the AI bottlenecks, the AI electronic producers, you've been seeing the software part of the tech indexes rally as well.
Yeah.
Yeah, it's definitely looking like a more broad buy everything market coming out of the bottom. And again, there's fits and starts across the asset classes, and that can be attributed to all the headlines due to the Iranian ceasefire, the straight opening, the straight closed. Okay, we're at a ceasefire. Oh well, someone just fired on someone else. So I think that can be explained there where some of these assets are flip-flopping, but it's definitely a pretty broad rally coming out of this
Yeah.
initial
So
ceasefire
yeah,
announcement.
I mean, and it's paid for you to be diversified this year,
Yes.
just like last year. So we had this what I'd call bear market and diversification for a long time, and now that's starting to prove to be a worthwhile strategy again. But even outside of that, I think going forward into the second half of the year, I think there's going to be two main things that are going to be worth paying attention to overall. Now, obviously, there's other things that could come up that are going to be worth looking at, but I think the two main things are going to be how does this AI theme continue to play out, and then what is going to be the position of the new Fed. So let's start with the AI theme. So just looking at returns, so we have an AI sleeve in our tactical models. And when we initially put this in, we kind of sat down and said, all right, what are the areas that we think are going to be the most important going forward? How do we, thoughtfully address this allocation? And then, how do we deal with it going forward? Because everybody's kind of on this theme, and as they should be, because it's the numbers are staggering kind of across the board. But when everyone's on the same side of the boat, there's going to be periods of volatility. And I think you have to understand you're going to either have to aggressively trade through it, which we're not, that's not really what we're trying to do, or you need to just establish a longer term strategic position that you can, maybe look to add to on an opportunistic basis. So when we came up with this, we've got, three positions in here. that we think represent a good uh, um, basket of securities that cover the whole AI ecosystem. So if you look here, you've got Defiance Quantum up 45% year to date. This is as of July 6th. You've got Cyber, which is the First Trust cybersecurity. A lot of software names in there, as Dan had mentioned, 31%. And then the TEMA electrification ETF, Volt, which has to do more with kind of infrastructure build out and energy up 38%. So, when we talk about the surprising moves in tech or the lack of, you can look at these and still see some big returns, but also some big drawdowns in there as well.
Yeah, and if we can drill down a little bit on why we chose these positions, the electrification ETF, that's the infrastructure build out for the US's aging electricity infrastructure and the need going forward with kind of the AI build out. The cybersecurity ETF, that's pretty self-explanatory. It's owning names in the cybersecurity sector. Now, quantum is one that's a little bit different.
I think it's a little misleading with the
It
name.
is very misleading. So I just want to shed light on this. So if you go in and look for a BlackRock or a Fidelity or a Vanguard kind of AI or semiconductor ETF, it's going to be extremely heavily weighted to some of the top names in not only that area, but the S&P 500, the NASDAQ. So you might be buying an AI ETF, but it's going to be 15% NVIDIA, 15% Broadcom, something like that. Since we already have a decent amount of exposure through kind of our broad market ETFs to those individual companies, we did a lot of research and sourced this fund. It's actually a fund that requires every company to have at least 50% of their revenue derived directly from large language models. So, there's a mix of all different types of software companies, chip companies, data center companies, even quantum companies in there. But it's also the thing that drew us to it is it's equal weight. So you're not getting so much exposure to these massive names. You're getting kind of a broad blanket to a lot of areas of the market. And, when you're seeing places like small cap and international outperforming, being a little bit more leverage to that lower cap scale is definitely benefiting you. So again, that one we get a lot of questions on. It's a little misleading. It is very devoted to that, AI and large language model sector of the
Not just
market. It's
100%
not just
quantum
100% a
computing.
quantum computing ETF. So yeah, I just wanted to touch base on that a little
Sure.
bit.
Yeah, and then I mean, from a demand standpoint, because this feels like the biggest thing. Everybody's worried that this build out is overdone. That at some point the demand's not going to be there, the revenues aren't going to be there, and this is all just going to fall apart. So this is a chart that we've sourced from one of the strategists that we use, a research company called 314. And they created what's called a GPU availability index. And they've tracked this now for close to 2 or 3 years. And the index is, looking at kind of on demand availability for different vintages of GPUs. So the B200, I think, is the most recent or newest technology, so to speak. And then the A100 is the oldest. So naturally, you would expect that there's going to be higher demand for the newer models as opposed to the older ones. But if you look at the top chart here, this number right now represents an availability of roughly, we'll call it 20. Oh, here's the number here, 22.6, which you can see that for a long period of time, this was much higher. So in their own words, what this says is that the demand for compute, for AI, for anything related to the AI ecosystem here, supply is over demand. But once you're getting under this 50% threshold, it's showing that the demand is high and the availability is low. And we were down in the 5% range earlier this year. And to no surprise, coming out of that, you've seen pricing increase and you've seen the semiconductor index run at an almost historic level. And you look and say, all right, well, this is starting to move back up, but it's still not even close to the threshold that they consider significant at right around 40 and 50%.
Now we're getting into the weeds, Doug. Yeah, I mean, there's a lot of, really interesting new ways to look at this AI trade right now. And this is one of the ones that is getting a lot of eyeballs. Another one is cost of tokens. When the networks get throttled, they'll raise the cost of tokens. And, if people will, pay for them or they won't pay for them, they'll either scale back or ramp it up. So, yeah, I mean, this is very interesting to see when you have all these companies building these chips. You have all these companies like Google doing the TPUs, making all of this compute available, and they're rushing to get as much compute available as possible. They're rushing to build data centers, and they're still not even making a dent. This is really showing that if we strip out capital expenditures, if we strip out, companies starting to, this is showing that people are still absolutely clamoring to get as much AI compute as possible. And again, we watch this closely. If we see this number, or if we see the lines on this chart ticking up, that shows you that supply is outstripping demand. You might see a little bit of a lull in some of these bottlenecks and some of these chip manufacturers. But at this point, I mean, it's still showing, despite all of the rallies, despite all of the memory rallies, the chip rallies, the data center rallies, there's still plenty of room and more demand than we previously expected.
Yeah. And then the other one was, AI is just going to come and kill everyone's job, and nobody's gonna have a job, and nobody's gonna have any money to spend. Well, the numbers are telling you kind of the opposite right now. So companies that spend more on AI also are able to increase their workers, and we can see by these two charts, we have all jobs and then entry level jobs, that high AI adoption companies are adding jobs at an increased rate as opposed to low AI adoption. You can see the low AI adoption is almost zero. So, this idea that we were going to just replace everybody, and that, who knows, maybe that happens further down the road. But when we look at this, it seems like it's the opposite. It seems like, the AI build out is increasing efficiencies and also offering the opportunity to add headcount to companies as opposed to reducing.
Yeah, I mean, I think this kind of speaks to the value of, for companies that are utilizing AI, they're getting more productivity per employee than a regular company that isn't using AI and isn't, even really scalable to AI. If you could say, hey, I'm going to bring on a person, and if we, invest in AI and help them do their job better, we can have them be 5 to 10% more productive. I mean, it makes hiring more economical for some of these bigger companies that are really ramping it up.
Yeah, yeah. I think there is valid concern that maybe some of this is ahead of itself. Obviously, there's going to be volatility along the way. We've seen periods where you've had some of these bigger names have big down days, especially in the individual names, and then even at the ETF level, like this is just the price of admission when, one, everybody's kind of on the same theme, and two, that theme has been going up aggressively. We always say, parabolic charts do not resolve themselves by going sideways. Like there are going to be periods where there may be a downturn here, but then again, I think you need to ask yourself, are we using that as an opportunity, or are we trying to trade aggressively around this? And for us, I don't think it makes a whole lot of sense to try to trade aggressively around this. I've heard a lot of comparisons to 2000, but I just don't think that there is enough similarities to declare this the next tech bubble. And if we see here, just looking at forward Ps and price growth of some of the tech leaders versus today versus back then. So both of these charts, are kind of related to the year 2000, but you can see the one on the left, Ford PEs leading into the market in the tech bubble were astronomically 300% higher than 5 years before the peak, right? So some significant movements, and you were paying triple digit multiples across the board for any company that had .com in their name, and some of them you're probably paying more because they didn't have any earnings. Now we look, the Ford P growth is, what is that? Less than 12% or 12% decline from 5 years ago. So we haven't even expanded multiples in the past 5 years. But we're supposed to look at this and say, oh, this is comparable to 2000. And then if you look at the price growth, which, okay, a little bit different, 778% in the year 2000. We're at 160%. And again, that number goes back 5 years. So it's not like that's happened over 2 years. We've had a good run. But again, the idea that this is just all going to fall apart like it did in 2000, I just think it's a lazy comparison.
Yeah, I mean, I completely agree. When the more and more I look back at this and dig into the data, it is the tech bubble was a very fascinating time. Um, crazier than the crypto bubbles, crazier than the whole, cannabis bubbles when they came out, the gamma squeezes coming out of COVID. The 2000, 2001 tech bubble was absolutely, it was pure absurdity. And again, this this is real money, real companies building real products that are getting real everyday use. Now, does that mean that it's priced to perfection and there can't be any volatility and people are buying up whatever in hopes that it'll go up? That absolutely could be the case, but um, yeah, this has much, much more staying power than anything we've really seen since pretty much the start of the internet.
Yeah. And I think back in 2000, if people weren't making 5 to 10% day trading a day, they were, firing their advisor, whoever was managing their money, and just saying, "Oh, screw it, I'll just do it myself." So yeah, that it was a crazy time back then. I think that rally was built on some hollow ground, but at the same time, I mean, if I think about things that can penetrate this rally, the idea of a hawkish Fed definitely has my attention. Even with earnings per share growth, projections through the next few quarters still outstanding. You've looked, and almost over the past, we'll call it 2 or 3 years, you've had actual numbers beating the expected numbers pretty substantially. And it's
Which
really
doesn't
hard.
happen often.
Yeah,
That does not happen
it's
often.
hard to have a bad market when you've got good earnings. Now we can talk about, are we going into peak expectations? But I think what concerns me the most is the fact that you've got, a new Fed chair who basically had his first meeting and came out and really surprised everybody. I think by not only maybe supporting the concern that he was a little bit hawkish, but also kind of blowing up the whole forward guidance template that the Fed was using. Now, just because he's not going to give it anymore doesn't mean the market's not going to create its own. But I think this is, to me, in the short term, this may be even more important than the AI theme. Because right now you have people who are very much of the opinion that the Fed is hawkish and that their plan is to raise rates. Then you have another subset of folks who think that the market is going to get caught off guard by the fact that everyone believes that the Fed is hawkish and that they have no reason to be hawkish right now. And then I guess there's people in the middle. But what do you think? I mean, if you had to bet right now, if the next move from the Fed is a hike or a cut, what would you say?
If I had to bet my own money, I would say the next move from the Fed is a cut.
Okay.
Now, I've seen a lot of, comparison charts from, now in the 80s where, you had the big inflation spike and then the reacceleration of inflation. And I think a lot of people are pulling that analog and kind of manipulating it to their own satisfaction. But when I'm looking at the landscape here, I don't see the justification for a rate hike. I think currently the Fed is unnecessarily, not maybe unnecessary, I think they're appropriately positioned, and any hike would be unnecessarily restrictive at this point based
Yeah.
on the current inflation numbers.
So yeah. So let's look at those. So if we go back to 2022, we can see that there was a massive discrepancy in the blue line, which is the PCE index, which is the Fed's quote unquote preferred inflation gauge. Then you have the 2-year treasury, and then you have the Fed funds rate. So, I mean, realistically, we could take the 2-year treasury out if we wanted to, but I think that's maybe an early indicator of where they think the Fed is going.
Yeah, that's
Um,
typically the 2 year is typically kind of the market's answer to where they think the federal funds
yeah.
rate should be.
So you can see back in 2022, inflation was almost 7 or 8%, and there's the Fed funds rate at the floor. All right. And the 2-year started to maybe sniff some of this out and said, all right, this is absurd. We've got this huge move up. Inflation comes back down. We're quote unquote restrictive for a long time. And finally, we seem like we found some equilibrium, maybe at the beginning of 2026. And then all of a sudden, you've got this Iranian situation where you've got energy prices that spike. Now you've got the 2-year rising, you've got PCE spiking, and you've got the Fed rate a little bit below that. I just have a hard time thinking that they're going to be oblivious to the fact that energy was elevated for what, 2 months, 3 months, and now it's back down to what, low 70s.
Hmm.
I just, without sticky wages, I would agree. I don't see how they look at this and see a reason to do this. And then, it sounds like, if this is true, and again, I'm not convinced, that they're turning hawkish at the exact wrong time. You've got 1-year inflation swaps, which are basically the market's assessment of the inflation rate, basically rolling over and going down hard. But then you've got sentiment language from the Fed going up in terms of being hawkish. So I don't know. I don't feel like they can be serious about being super hawkish right now. I just don't know that the data backs it up. Yeah, the headline inflation numbers are high, but is that going to be embedded inflation? I just don't see it.
Yeah, I mean, you can't hike your way out of a supply constrained market like oil. Hiking rates isn't going to ease inflation related to energy costs. That's just not something that the Fed can do. Interest rates aren't going to open the Strait of Hormuz. They're not going to make OPEC increase their output. I, to me, I think if you went in and looked at PCE and CPI and stripped out energy, you'd say, wow, this is a much rosier picture of what our inflation landscape looks like. So and again, not to get political or anything, but I don't see a world in which Donald Trump, who has been very outspoken on wanting lower rates and an easier Fed, to appoint someone who's an actual hawk. I mean, he might be a dove in hawk's clothing. I don't know, but I just don't see a situation where he gives Powell all sorts of flack for years and years and years, and then all of a sudden appoints a hawk and says, "Okay, go ahead and do what you want."
Yeah, it doesn't really line up. At the same time, he wants rates lower and he wants a weaker dollar.
Hmm.
And what has happened kind of since the beginning of this year, we've started to see the dollar curl up a little bit. So the orange line here is the the dollar index had been going down along with the 2 year. And now we're seeing both kind of spike back up again. So this goes along with the charts we just looked at to say, all right, short-term inflation is moving higher, but is that going to be a sustained number? And going back to what the Fed's first move is going to be, I don't think they should do anything.
Yeah, I mean,
There's, I don't think they have justification to cut. The economy seems like it's doing fine. The jobs market looks okay. If you're going to assume inflation is going to naturally normalize after this energy, spike flows through the data, unless something changes, I don't know. If it were me, I'm staying put, and I'm telling the market I'm staying put until I have a reason not to. And
yeah, I mean, I think the only thing that really changes that in either direction, I think, is if we get sticky wage growth, I think a hike could very well be on the table. And I think if you get, really bad jobs numbers and employment rate rising, I think a cut could come. I think that is the main issue. I think it's jobs right now. And right now it's not doing much. You're not seeing it move up or down. You're just seeing a pretty solid job picture across the board.
it's funny because I can't remember a time where there was so much ambiguity in what the next move for the Fed is going to be. We had this long period of time where they basically cut to zero. They couldn't cut any further. I mean, I guess there were some periods where they were talking about the idea of possibly running negative rates like they did in Europe for
Hmm.
a little bit, but they never tried that experiment. But all through that time, there was absolutely nobody who thought that even the whiff of a rate hike was on the table. And again, it took the world shutting down, being flooded with money, and supply just basically disappearing overnight to move off that position. I don't know. I think it's really going to be fascinating because I think some of the asset classes that you're seeing that have performed better than normal over the past year or two have been predicated on a weaker dollar. You have international weaker dollars a tailwind for that asset, gold, small caps to a certain extent. I mean, a lot of these diversifiers have really fed off of that. If for some reason the Fed turns hawkish and the dollar strengthens, I think you're gonna run the risk of unwinding a lot of these trades that are on right now, and you could have portfolios looking quite different than they would right now. So I hope that doesn't happen.
Yeah, I mean, I agree.
In terms of where we are right now, let's kind of walk through some of these bullet points. So, from a stock perspective, model equity allocations remain at neutral. There may be some drift above that neutral number just from natural market growth, but right now our models are sitting at neutral allocations to equities. I think we remain pretty diversified across the board, large, small, value growth. The leadership has shifted post-conflict. We saw that in the charts earlier. And it's like I said, it's kind of paying to be diversified right now and to kind of barbell your exposure between both sides. Earnings margin projections really remain strong. And I think, as we mentioned, the AI theme, emerging markets and small cap, I think they've been the biggest gainers over the first half of the year. And I think they have the potential, as odd as it sounds, to still have the most opportunity going into the second half of the year, just from the setup of kind of valuations, flows, and earnings projections. And then on the bond side, our duration, it remains below benchmark. I think once we get more direction on what the Fed's going to do, we may adjust that a little bit. But for now, we don't feel like taking on excess rate risk is necessarily a good idea. Our core bond exposure is exclusively investment grade corporates. And then, from an alternative standpoint, we're still trying to hold assets that can provide us with returns that are maybe outside of the U.S. rate curve. So gold, commodities, managed futures, those had a really good year last year. They've been a little bit up and down this year, but we still believe that adding those to a portfolio right now can give a good boost to return profiles and also provide some good diversification. So, Dan, you have anything you want to add to this list?
No, I mean, I think you've pretty much covered it. I mean, again, it's been a really good year for diversification. It's been a really good year for a lot of different areas of the market that have been out of favor for a while. So we're definitely benefiting from having kind of that barbell with our AI sleeve and then some of the more diversified asset classes like small cap, international, emerging markets. The alternatives, I think we still are seeing an environment where investors are clamoring to get hard assets. I don't think that's necessarily going away. I think that could be a longer term theme. So we're really happy to own those positions and think they're going to work well for us. Bond duration, we don't want to go above the benchmark if we think there's a possibility that rates might be continuing to rise. And, we're starting to see that a little bit. If we see an environment where we get, a clear path on rates, we get a better idea of what the Fed's thinking, we might increase that duration to lock in some higher rates for longer durations. But at this point, I think we're pretty happy and comfortable with where we are.
All right, last question. Are you going to continue to watch the World Cup now that the U.S. is out?
Well, I didn't start, so
So the answer is no.
yeah, I'm not a soccer guy. I have a group chat and I've been following along through everyone's text. So I did learn that the USA lost last night. So
Yeah, it was disappointing.
hmm,
I think everyone was excited that this was a different U.S. team, that they were going to be the aggressor. We were going to play attacking soccer, and it felt like we got into a time machine and watched the old U.S. teams that just sit back and try to think they are going to look like Spain and pass the ball 100 times into the box and then get a perfect setup. But yeah, I was definitely disappointed by that. So
I will say my favorite content right now on social media is, Europeans and, people from all across the country experiencing America for the first time. If you haven't really seen any of those videos, it's pretty great.
I've seen some of the food ones.
Oh yeah,
So specifically,
Texas
Texas
barbecue and
barbecue.
Buc-ee's and
Yeah, I saw the Scots. They basically drank all the Sam Adams in
yep.
Boston.
I trying a lobster roll for the first time and clam chowder. It's been really fun to watch. It's pretty uplifting to see what people think of the United States. So I
Yeah.
think a lot of people are changing their opinions on the states. So that's fun to watch.
Yeah. Okay. Well, as always, questions, comments, concerns, please don't hesitate to reach out to your advisor. We're happy to address those head on, either through an in-person meeting or a phone call. The next time we'll be back doing audio only. I think we're going to try to do the videos, maybe as quarterly updates, and or if we've got really volatile markets that we think visuals will be appropriate for. But in between there, I think we're going to stick with the audio only podcast, and we should have the next one of those out here in the next 2 weeks or so. So until then, thanks for joining us, and we will talk to you soon.